Just checking my live. Let's go. I mean, it's Saturday today. Could do the end of week review, but I missed out Friday. So I'm gonna get into Friday. Get my cursor out for you. So, London session, we did see price start at the lows of Asia, yeah? If I get off screen, zoom in, I can also see that price starts off inside a 1 hour FVG, but it then tips down for a discount. So I have a bias that I'm gonna go for some buys. First FVG's the first FVG's issued, and I'm still watching price. But because price is in internal liquidity, if I look at these lines here, these are the labels. So I've got price in between yesterday's close and yesterday's open. I don't really like what price is trying to do, because it's Friday. I know, or I've got a bias that price is going to return back to the low of the week. But because we're in internal liquidity, I'm actually waiting. Instead of executing, I'm going to wait because I know price is going to be choppy. Why wouldn't it? So, well, that and watching the chart, because I've watched GJ for so long, where I now know that's GJ's behavior. If there's an opportunity for a fake out, GJ will fake out. Feel me? Unless there is some higher time frame liquidity taken out and there's an announcement to complement it. So for example, if we've taken out buy side liquidity and we're, say, bouncing off the high of the week, and then I've got I want to say CPI, but I wouldn't trade CPI. Let's say CPI because Friday was CPI. And it's a CPI announcement, and then the forecast is X, and the forecast is really low, and then the actual is identical. Then we know price is gonna crash. So yes, that's when I know that's right for price crashing back down to the low of the week. But I'm not seeing it here today or on Friday, so I'm holding back on it, and rightly so. Price did turn back around to return to the FEG. So I've got my 1 to 6. Well, let's see what it is here. Is it 80? No, it's not 80. It's not 80. Probably had a bias price. I hit that key level. 678. Boom. 5.6. I'll take it. So going up for highs, I actually thought price would go for 1 to 2. So if I get a 1 to 2 out of my execution, let's see what it looks like. Get my stop loss, bring it back up to the same level, bring that down. Move. Cool. So that's where I'm at. I'm actually trying to hit this 1 to 2, and I can see that price actually did rally. So let's see why I didn't make the money. If I get in this entry candle at 12.25, I'm in, but then I see price, unfortunately, after rallying up, crash straight down. How many pips did it go up? Ooh, move. 9.2 pips. before crashing straight down into my stop loss, then rallying back up 12.5 pips, then crashing down again and shooting back up for my TP. So what I'm about to say isn't hindsight. This is just a rule. We don't trade CPI. And this is why we don't trade CPI. Because price isn't really, or the market makers or the institutions or whatever, whoever you want to call it, aren't really trying to give it to you. Not today. So while your execution might be amazing and it may seem to be going fine, it's just not trying to happen for you. So that's the point. Here you can see more analysis where I was just going through some analysis with my student about extra trades. So after the announcement, you could try to say, okay, cool, after CPI, I'm still going to continue. I know some traders still do that, or do that with other announcements, which is cool. However, CPI, unfortunately, no, it will take you into profit, but then turn around and do the exact same thing. It's the exact same model where liquidity grabs are concerned as the one prior. Same session. High and low and high and low.